Hey everyone, let's just get right into it. To the untrained eye, financial charts look like a completely chaotic mess, right? Just random lines, sudden drops, unpredictable spikes. It's overwhelming. But to a market detective, oh, those charts contain footprints that are as clear as a crime scene. In today's explainer, we're not just going to read price action, we're going to investigate exactly who is pulling the strings behind the scenes. We're hunting for massive, hidden footprints left behind by a profound imbalance of supply and demand. So get your detective notepad ready because we're about to decode the true structural secrets of the market. It's a surprisingly simple question, but the answer is going to completely change how you view trading. Look, a lot of beginners step into the financial markets thinking that their own small trades or, the actions of millions of everyday retail investors they read about on Reddit or in the news are what actually cause prices to shift. But let's take a step back and look at the sheer scale of the market. The volume of a retail trader is quite literally just a tiny drop in a vast, endless ocean. Even if thousands of us clicked buy at the exact same millisecond, we just don't have the financial gravity to move major asset prices even a fraction of a percent. The massive surges and crashes you see on your charts, yeah, that's not our doing. So who is the real culprit? Who actually has the power to violently shift the market? Well, that is the exact mystery we're unraveling today. Okay, let's dive into this and lay out the case we're building today. We'll start with the psychology of price, then we'll officially meet the smart money, solve the unfulfilled order mystery, compare aggressive versus regular zones, learn to find the V-shaped footprint, and finish up with a practical zone hunting checklist. Section 1. The psychology of price. We really need to understand the emotional drivers behind why these markets move in the first place. Think about it like this. Whether you're at a local farmer's market trying to buy the last basket of fresh tomatoes, or you're logging into your brokerage to buy shares of some massive tech company, the fundamental rule of all commerce is exactly the same: supply and demand. But behind those cold, calculated numbers is human emotion. When things are going incredibly well and an asset's price is skyrocketing, a psychological trigger kicks in. We've all felt it. FOMO, the fear of missing out. People see their friends making money from the sidelines and they just rush in to buy. This insatiable desire creates a massive surge in demand, causing prices to absolutely explode upward. Now, flip that around. Imagine a sudden global crisis hits. Panic sets in. Investors become terrified and just rush to liquidate everything into cash. Suddenly, the market is completely flooded with supply, but nobody wants to buy. When supply overwhelms demand like that, the price drops like a stone. Every single movement on a chart is really just this emotional tug of war happening in real time. Moving to Section 2. Meet the smart money. Let's identify the true suspects behind the charts. So, now that we know supply and demand dictate the price, we need to identify who actually possesses the raw capital to disrupt this balance in the blink of an eye. In the financial world, we call our prime suspects smart money. These are the international megabanks, the colossal hedge funds, the market whales holding billions with a B of dollars. Imagine a massive institution that needs to park $2 billion into a specific asset. They aren't trading based on fleeting emotions or some random news headline. They're trading based on strictly calculated algorithmic limits. The sheer force of their capital is so incredibly heavy that when they decide to enter a market, they cause a literal seismic shockwave. They are the ones leaving the structural footprints we want to follow. Now, what's really interesting about this concept is a breakthrough pioneered by former banker Sam Seiden. Obviously, supply and demand is as old as trade itself, but applying it directly to chart analysis to track banking footprints, that was heavily systematized by his work. Drawing from his own experience inside the banking system, he revealed a really crucial secret. Institutions simply cannot hide. When you trade with billions, there's no stealth mode. You are forced to leave massive, identifiable footprints right there in the open market for anyone who's trained to look for them. Which brings us to Section 3, the unfulfilled order mystery. Why do these massive institutions leave such obvious clues behind? Okay, let's walk through the actual mechanics of the order book very carefully, because this is the aha moment where everything clicks, especially if you're new to this. The whole reason institutions leave footprints is due to a lack of liquidity. Basically, they just have way too much money. Let's say a major bank decides that $4,250 is the absolute perfect, cheapest price to buy a specific asset. They instantly place an order to buy 5,000 lots. But there's a catch. At that exact microsecond, at that exact price point, there are only 3,000 lots available from sellers on the other side of the trade. So the moment the institution's massive order hits the market, it violently eats up all 3,000 available lots. Because that buying pressure is so intense, the asset's price immediately skyrockets away from $4,250. But wait a second, the institution wanted 5,000. They only got 3,000. What happens to the rest? That leftover number. 2,000 lots. This right here is our smoking gun. The institution doesn't just cancel this order and walk away. Nope. Instead, those remaining 2,000 lots are left behind at exactly $4,250 as what we call passive limit orders. The smart money knows the price will eventually wander back down to that level, so they wait. And this exact dynamic creates a highly reactive demand zone. It's essentially a ticking time bomb of dormant buying power. As market detectives, finding the specific pile of waiting, unfulfilled orders is our primary objective. Section 4. Aggressive versus regular zones. It's time to classify the evidence we find on the chart. So the crucial point is that as we classify our evidence, we need to realize not all footprints look the same. We generally see two types of zones. On one side, we have aggressive zones. These act like a violent lightning strike. Price hits a specific level and instantly, violently reverses direction, forming a sharp V shape. This tells us, without a doubt, there is a massive block of immediate, unfulfilled limit orders sitting right there. On the other side, we have regular zones. Think of these as a slow, psychological tug of war. Price moves into an area, it kind of consolidates and chops around for a while as buyers and sellers fight it out, and then it slowly changes direction based on shifting market perception rather than one sudden giant block of institutional money. For beginners and seasoned detectives alike, hunting aggressive zones is absolutely the ultimate strategy. Why? Because it completely removes the guesswork. Regular consolidation zones, they're complex, they're messy, and honestly, they can trap you in a lot of indecision. But aggressive zones provide an incredibly high probability of success because they represent undeniable, explosive institutional presence. We want the areas where price touches and reacts instantly. That gives us a clear, undeniable signal to execute our trade. Section 5. Finding the V-shaped footprint. Let's do some step-by-step field work. Let's put on our trainer hats for a second and step onto the field. Imagine you're looking at a 1-hour Bitcoin chart, or maybe the S&P 500. You're scanning the price action, but you are not looking for gentle curves or little dips. You are actively searching for violence in the market. You want to spot a moment where the price took a sudden, extreme drop, and then, without any hesitation, without moving sideways at all, it rocketed right back up. This leaves a severe, sharp V shape on the chart. That shape is the visual manifestation of that math problem we talked about earlier. It means price fell, hit a colossal institutional wall, like our 5,000 lots, absorbed whatever liquidity it could, and bounced instantly. Now here's where so many new traders make a critical error. They draw their zones way too wide, basically just painting massive blocks over random candles. Let's do this correctly. Take your rectangle drawing tool on your platform. Anchor the very bottom of your box to the absolute lowest tip of that V shape, the exact pixel where it reversed. Then, draw the top of the box upward, covering roughly the bottom half of the entire V structure. Boom! You've just outlined the institutional demand zone. Now, if you decide to place a trade when price eventually returns to this box, you have to know where your safety net goes. Your stop loss must be placed just slightly below the very bottom of the box you just drew. Why exactly there? Well, because if the price manages to push completely through that bottom line, it means that massive institutional wall of money is gone. The footprint has vanished, your trade thesis is officially invalidated, and it's time to exit the scene safely. And this brilliantly illustrates another point, because I gotta warn you, things aren't always perfectly clean. Institutions are incredibly cunning, and they love a dirty tactic known as a liquidity sweep. Remember those 2,000 remaining lots our bank desperately needed to fill? If they can't find natural sellers, they will force the issue. They will intentionally manipulate the price to dip to slightly below the very demand zone you drew. To a beginner retail trader, this looks like a terrifying breakdown. Panic sets in. Retail traders rush to hit the sell button, and their stop losses are forcefully triggered. And who do you think is waiting right there at the bottom with open arms to scoop up all those panic-sold shares? The smart money. They use your panic to fill the remaining 2,000 lots and then instantly launch the price back upward. As a detective, recognizing a liquidity sweep prevents you from falling into the ultimate trap. Section 6. Your zone hunting checklist. It's time to put all this theory into actual practice. Let's move to the charts and see how this builds into an actionable checklist you can use right now. Open up a 15-minute or a 1-hour time frame. Train your eyes to completely ignore the noise and scan exclusively for those rapid, violent V-shaped reversals. Once you spot one, carefully draw your rectangle from the very tip of the V up to its midpoint. And here is the absolutely most crucial lesson for any new trader. Do not chase a moving train. If price is exploding upwards, let it go. You must act like a patient spider sitting quietly in a web. Just wait. You wait for the market to exhaust itself and eventually wander back down into your beautifully drawn box. When the price touches that zone for the second time, that's when you watch those passive limit orders trigger, launching the price once again. Look, the financial markets are not some casino of random fluctuations. They are a battlefield dictated by supply, demand, and colossal institutional capital. You now have the tools to look past the illusion. You know how to spot the unfulfilled orders, you know exactly how to draw the structural boundaries without making rookie mistakes, and you know how to protect yourself behind the shield of smart money using your stop loss. So what does this all mean for you? The next time you open up a chart, will you just see chaotic lines? Or will you see the precise footprints of smart money? Grab your charts, follow the evidence, and start hunting. Happy investigating.